is a TaxCast special feature from the Tax Justice Network. For our monthly TaxCasts, with news, features and expert analysis you won't hear anywhere else, go to www.tackletaxhavens.com/TaxCast. And you can also find us on iTunes. If a country has a large financial sector, that must be good for its economy, mustn't it? Actually, too much of it can weaken the economy, slow growth, erode democracy, foster corruption, and increase inequality. The TaxCast looks at the latest Tax Justice Network research on the similarities between the resource curse and what they're calling the finance curse. In some resource-rich countries, despite the hundreds of billions of dollars generated, ordinary citizens can be worse off than if, for example, oil had never been discovered, or indeed, if they didn't have an oversized financial sector. Economist John Christensen.
An oversized finance sector, particularly an offshore financial sector, can dramatically change your economy. It'll crowd up pre-existing sectors. It'll make you politically dependent upon a single economic sector. There's a risk that your politics will be captured by the interests of that industry, making you politically captive to that industry. There's high risk of corruption flowing on from that. So in many respects, the finance curse acts in the same way as the resource curse in shaping your economic and political outcomes in very negative ways. So it doesn't just affect other countries negatively, it'll also affect the host country negatively.
Of course, no one's saying financial services aren't vital to the economy. We need banks. Businesses need banks, insurance and accounting services. So how big is too big? The Bank of International Settlements says finance turns bad when private credit's equivalent to 100% of a country's GDP, gross domestic product. In the United States, it was 200% at the time the financial crisis hit. But what about the benefits and contribution financial sectors make to the economy? Well, they're often exaggerated. Professor Prem Sikka on the City of London employment figures.
It is attracting a lot of concessions and support from the UK, but its economic base is very, very shaky. In 1991, around about 1 million people were directly employed in the financial sector. In 2012, when the number is 1,017,000. So there is no employment growth. So when the governments tell us that we must have support for the offshore tax haven, the hedge funds and private equity, the number of people directly employed in the finance sector is absolutely flat.
Not only that, but many of them have low-paid jobs in call centres and essential domestic retail banking services, which would exist whether or not they were based in London's financial sector. And job creation in casino banking, the cause of so many problems and so many claims about wealth generation, are much lower than that. Professor Sikka again.
What about the contribution of the City of London to the GDP? Well, it is around 6 to 8% of the GDP. And the manufacturing sector, even though it is shrunk, is still about 3 times as large in terms of the importance to the GDP, in terms of jobs, even more. So this curse kind of made policymakers, governments believe that finance is very important, but it has neither generated a GDP, neither generated the jobs, and what London has become is a home for hot cash. But that doesn't mean you have anything which is sustainable, anything which is durable.
Indeed, it's now clear that the speculative arms of oversized finance centres go hand in hand with economic crisis. We don't yet know what the final financial costs of bailouts we've paid for around the world will be, but it seems the largest finance sectors are now net consumers rather than contributors to tax revenue. The UK is now one of the most unequal societies in the developed world, and the OECD believes the City of London's financial sector's been a major factor. And there's another way a centre like the City of London damages growth in the real productive economy. John Christensen again.
It's been in the interests, for example, in the case of Britain, but for the City of London, they've always wanted to have extremely high exchange rates, real exchange rates and nominal exchange rates. And that's made it very difficult for productive industries in the rest of the economy to survive because they need lower exchange rates in order to compete on the world markets. Other pre-existing industries can't possibly compete on the world markets, so they're either diminished or totally wiped out, and they go from being exporting countries of other goods and materials and services to becoming importing economies. wiping out jobs, wiping out diversity within the economy, and becoming overly dependent upon the single sector.
So how's it working on the ground for a place like the island of Jersey, whose major offshore financial services sector accounts for over half of their GDP? I spoke to Jersey residents and tax justice campaigners John Hayes and Ted Vivett. And how do you feel about this notion of the finance curse? Is that something you relate to?
Totally. Oh, absolutely. They're so right. That's exactly what it is.
We find what's happening in Jersey is immoral, and we've been fighting this in our own way for a long time now. The authorities in Jersey strongly deny that Jersey is a tax haven. They're in denial.
So if it is a tax haven, which they deny, then that's a great thing because it's attracting lots and lots of money from all over the world, which is great for the Jersey economy.
No. What happens with that money? It's usually transferred straight through to London. So we're a vessel for supplying money to London. Any company operating in Jersey that is not registered in Jersey, and there are a lot of them making a lot of money, pay zero tax. Anything associated with the finance industry, instead of paying the usual 20%, only pay 10% tax.
Last year, the tax take from corporate was down to 18 million, from 108 to 18 million, and the tax take from people was up to 86 million. So the whole tax take in Jersey has changed completely because we don't want to lose the finance industry. So one offshore jurisdiction says, well, we'll offer you a 5% tax rate. The next one says, no, we'll do it at 4%. And there's this race to the bottom. And we reached the bottom and we said we're going to do it for zero.
So basically you're saying that ordinary people are paying the price, literally, in their tax bills.
Yep. We're the ones who are paying for the development of the finance industry. And the take from the ordinary people will just go up and up and up.
And our tourism industry, which was one of our major industries, is down to about 2%, and our agriculture and industry is about 1%.
And so the finance sector's crowded out Jersey's tourism and agriculture industry dramatically, and it's now one of the developed world's most unequal places. John Christensen from the Tax Justice Network.
There needs to be a rebalancing of the global economy. The tendency towards speculative trading, towards investment banking activity, which has largely been casino activity, needs to be very much more effectively regulated. And I think that a financial transaction tax brought in at a reasonably high level and as global as possible would take away much of the incentive to engage in this socially useless speculative trading. And that would force the banks to focus more on what they should be doing, which is investing in long-term businesses and productive activity rather than in speculative trading.
You've been listening to a TaxCast special feature produced by me, Naomi Fowler. For the Tax Justice Network's monthly TaxCast, go to www.tackletaxhavens.com/TaxCast. For more information on the Tax Justice Network, go to www.taxjustice.net.